Hey guys, so today I want to talk about an advanced strategy in investing. One of the things that's very common out there in investing is what's called an ETF or an exchange traded fund. ETFs have really been taking over the managed funds business as a whole. Mutual funds, that kind of traditional product that you hear about all the time, has been losing share to ETFs for a decade or more now, and ETFs have really become much more popular. For one thing, because they're traded on the exchanges directly, and so it's very easy to buy and sell them. So what we're looking at here is the ETF for SPY, the S&P 500 ETF. Now, this is the largest ETF that's out there. As we can see, there's over $260 billion tied up in this ETF. So it's a substantial portion of money, and it gets traded hundreds of millions of times per day. The average volume over the last 10 days, we see here, over 108 million shares traded. Now, what's really interesting about this ETF, of course, is you can use it as an investment opportunity, but you can also use ETFs like this one for trading. Now, SPY is made up of the S&P 500. That's 500 large cap stocks throughout the US stock market. So, what can you do with that? Well, the answer is that if we know what the portfolio for SPY is, and SPY will be happy to tell you what their portfolio is, well, you have the right with an ETF to do what's called creation and redemption. More on that in a minute, but let's just take a look at the portfolio for SPY here to begin with. So we see as SPY holds a whole bunch of Microsoft, Apple, Amazon, Facebook, etc. They've got about 6%, 5.5% of their assets in Microsoft, about 5% in Apple, just under 4% in Amazon, about 2 or so in Facebook and Berkshire Hathaway, etc. And we could look at SPY's characteristics, things like their price relative to earnings, their price to book, their price to sales, etc., to see if this was a good investment or not, right? And, of course, these figures, price to earnings, etc., they're all based on all of the underlying stocks. The point here is that when you look at SPY, it's really built around the individual portfolio. There's no active management here. There's no decisions being made by executives at SPY or anything of the sort. The only thing that really matters is what's going on with the underlying constituents. Well, this leads to a big trading opportunity. If the price of the components in the ETF are more than the price of the ETF, then you want to buy that ETF and exchange it for the components. So if the value of Facebook plus Amazon plus Berkshire Hathaway, etc., the value of all of these individual components multiplied by the percentage that they represented in the ETF was more than the cost of the ETF, then you'd want to buy that ETF, and you can literally exchange that ETF, those ETF shares, with SPY in exchange for the underlying stock. They have to allow you to do this. It's part of the requirement for setting up the ETF in the first place. You buy those underlying components, you trade it in for the underlying ETF, and then you can turn around and sell the ETF, and you make a small profit. So if it cost you, say, $5,000 to buy the underlying shares, and then you were to trade in for the ETF, and the ETF were worth $6,000, well, then you spent $5,000 buying the underlying, and you trade for the ETF. The ETF is worth $6,000. You sell it, you make a $1,000 profit, and then you do the whole thing again and again and again and again. That's called arbitrage. This is one type of arbitrage, and it's a very common strategy in the investment field. Now, sometimes you have the opposite happen. If the price of the components is less than the price of the ETF, okay, well, we could buy the components and exchange for the ETF itself, okay? So we could buy those components, the individual underlying, and exchange for the ETF. That's called creation. So we've got to look at the value of the underlying versus the value of the component ETF itself, right? So if we just use as an example, if the price of those components is more than the price of the ETF, you buy that ETF, you trade it for the components, you sell the underlying. If the ETF costs $5,000, the components are worth $6,000. Buy that ETF, exchange it for the underlying shares, turn around and sell them. That's called redemption. If the price of the components is $4,000 and the ETF is worth $5,000, buy those underlying and then trade it in for the ETF, which is worth $5,000, sell that ETF, make $1,000. Redemption, creation. That's a very, very big opportunity in the electronic trading markets that are out there today. You can do this literally thousands of times per day, and this is a prime strategy used by high-frequency traders that are out there. You might have heard that term, HFT. Well, this is one of the big strategies they follow. Now, for our purposes as an individual, there's another thing that we can do, and that's to look at what's called the net asset value. So this chart shows us the premium or discount that the ETF trades at over the last 12 months. And what we see here is most of the time, in the case of SPY, because it's pretty liquid, it trades very close to the underlying value, right? That's what this chart over here shows us. So in February 2020, as an example, that was our biggest change from kind of net asset value or fair value. What we see here is SPY traded at 0.25% more than net asset value. Back in August, it traded at 0.1% less. Now, SPY is super liquid, but for a lot of the less liquid ETFs that are out there, you'll sometimes see they might trade at 0.5% or 1% or even 2% above or below their net asset value. Net asset value just tells us the value of the underlying. Okay, so whenever we see that the stock is trading at a discount to the actual value of the underlying, we should buy that ETF and wait for that negative NAV to disappear, right? That's what we see even with something as big as SPY. If you were to buy when NAVs are negative, they eventually go back to positive. That's consistently true. Now, in this case, that percentage is fairly small. But for a lot of the less liquid ETFs out there, the less popular ETFs, those percentage changes can be quite a bit more substantial. And the nice thing about this opportunity is that we can do it almost risk-free. We can hedge ourselves using the underlying and just try to capitalize on that NAV returning to zero. Or I should say the discount to NAV returning to zero. This is how advanced traders make money using ETFs. I'll see you next time.